Okay, thanks everybody. If you could take your seats for the panel, Attracting Investment into Africa's Financial Sector. What do investors want? And William Tay Pamar is our moderator. Thank you.
So, can you hear me? No? Hello? Yeah? Hello? Yeah? Works? William Tay Pamar here. The bad news is that this panel should have been moderated by William Conchu, that you may know. William has been retained in Paris, so he asks me to take over. The good news is I have the same name as him, so it's easy for you to. I'm William. And the second good news is that he gave me a list of questions, so I'm just taking over. So be nice with me, please. The African financial institution market is very large, as you all know, exceeding $2,000 billion of assets. It's still growing quite fast, particularly in sub-Saharan Africa, where we, William and I, are working mostly. And we have seen the development of big Pan-African institutions recently, like Attijari, Wafa Bank, Ecobank, UBA, etc. But there's still a room, of course, because these markets are largely under-penetrated relatively to other emerging markets or relatively to developed markets, because of the low financial inclusion, because of limited banking infrastructure. So what we are going to try to assess is what are the investment opportunities and what do investors want, which is a large question actually. And to do this, we have a panel of very distinguished people. We have Maria from CDC, we have Mahin from Fitch, we have Konstantinos from Moody's, and Ameya from Flourish Ventures. They are going first maybe to introduce a little bit themselves.
Yeah, happy to. Hi, everyone. I'm Maria Largi, and I head the Financial Services Equity team at CDC. Some of you may have just heard Stephen Priestley speak before this, but just in case you weren't here for that session, CDC is the UK Development Finance Institution. We currently have about $9 billion in assets, and 35% of that is in financial institutions. So a very, very large part of what we do. On the equity team, we've invested just over $850 million in 13 investments over the last 8 or 9 years, and that's across both Africa and South Asia, because these are the two geographies that we cover.
Hi, everyone. I'm Ame. I hope this is working. Yes, it is working. Hi, everyone. I lead Africa investing at Flourish Ventures. We're an early stage VC fund that focuses on financial health. We have $500 million of assets under management, around 80 fintech companies globally in our portfolio. And we invest in entrepreneurs in emerging markets who are trying to crack hard problems, some of which we're going to talk about today. Very excited to be here. Thank you.
Excellent.
Hi, everyone. My name is Konstantinos Kyprios. I'm with Moody's for the past 15 years and been rating banks and financial institutions in Africa and emerging markets. In Africa in particular, over the last few years, we have seen a significant increase in our rated universe. We rate now over 60 banks and financial institutions in the continent.
Thanks. Hi, everyone. My name is Mahin Disnaika, and I head up the African Bank ratings coverage at Fitch Ratings. I'm based in London. So at Fitch, we rate around 40 financial institutions. From commercial banks to bank holding companies to development banks to subsidiaries of international banks. Our coverage is around 40 names. There's a concentration of ratings in some of the most developed capital markets, South Africa, Nigeria, Kenya, and so on. That's about it, really. And again, we're seeing more coverage coming out of the region.
Thank you, Mahin. So we are going to start with on the equity side. With the equity, I'm asking now Maria and Ameya maybe to give us a little bit of the experience. So what are the types of opportunities you are looking for? I think that you are very different animals, you two, because we have a DFI and a startupper. What are the investment opportunities are you looking for? And what sort of investment themes, what sort of, what sort of focus, investment stage, and basically, what sort of investments are you looking at, in the financial sector? Thank you.
So at CDC, we're looking for long-term partners, strong management teams that are trying to grow their business and can have significant impact, really. So we won't look at as early stage, I think, as my colleague here, but we will look at pre-profit companies all the way to mature commercial institutions. We like to take significant minority stakes, so we don't have any hard and fast rules, but enough to give us a stake where we think we can add value on the board, where we think we can bring quite a bit in terms of governance around ESG, financial inclusion, et cetera. We will invest across the continent. We do have some focus countries where we've set up representative offices. That includes Kenya, Egypt, Nigeria, but we can invest across the continent. And in terms of subsectors, historically, or I should say up until now, we've mostly done traditional lending businesses, commercial banks, microfinance institutions. But in our next 5-year strategy, which kicks off at the end of this year, we're going to be looking at more innovative and earlier stage businesses models. So this will include fintech, specialty lending like affordable housing, ag finance, SMEs, insurance. In some instances, maybe more fragile markets, we will still look at banks, but we're looking at extending to other subsectors.
And what's your ticket size?
Ticket size, yes. So we do have a minimum ticket size of $10 million.
$10 million.
We are pretty flexible on the upside. The largest investment we've made is about $200 million. And so we can make a wide range.
Excellent.
I can talk about, yeah, sure. So let's define early stage, right? Because we don't just fund 2 people in a PowerPoint presentation. So we do seed, Series A, Series B, so there should be a company, there should be a product, should be shipped, there should be some revenues, there should be some traction, and then we come in and provide capital to scale the business. But let me take a step back and talk about where we see fintech on the continent and what trends we see emerging, right? And then I can talk about where we fit in that jigsaw puzzle. Mm-hmm. Well, in our view, fintech investments and exits move in these time windows that are 3 to 5 years, right? They huddle together because they are targeting a certain market at a certain evolution of technology. So for example, I think the first wave of VC investments in fintech in Africa was in payment companies. That happened, M-Pesa was the big grandfather of all, but it was built on an existing captive telephony network. When we're talking about independent startups emerging, I think that was around 2015, 2016. And companies like Flutterwave, Interswitch, DPO, Paystack, which have now seen exits more recently, were funded then. That was the window of funding, right? And we funded Flutterwave, which was a great investment in hindsight, but it was all about lowering the cost of payments. That was, I think, wave number 1. Wave number 2 was built on the digital payments. What can we do on top of digital payments, right? And this was companies that are providing credit and debit on top of payment networks because you can disperse money and collect money quite easily. And now, this is where you see Branch, Tala, the new challenger banks, Kuda, Fairmoney, all of these guys, right? So it's payments, then banking on top. And now we see that, finance is becoming invisible. I think fintech will become invisible, just like internet became invisible. And it will be embedded in the fabric of our daily lives. And when you're buying something online, when you're getting into a taxi, fintech will be part of that product stack and you won't see it. So for example, now with Klarna, when you're checking out, you just get an option, pay through EMI. That's actually a pretty complex credit product sitting behind it, which is analyzing your shopping data, connecting with a bank to get wholesale credit and funneling it all in 1 second. And that's where we see the future of finance, where finance becomes part of other things that enjoy a central place in your daily life, right? So there'll be platforms like Amazon, there'll be plugins like Klarna, and then there'll be plumbing, which is providing, say, the wholesale capital and all of that stuff.
Okay, excellent.
Our ticket size, I think. I
Yeah,
almost
maybe,
hear the
yeah.
question wrong. Yeah, we'll do $500,000 to $7 million as the first check,
Okay.
and we'll stay invested till we feel our capital is catalytic.
All right. Okay. And are you acting in some countries more than in others? I mean, what's the picture of this fintech?
Yeah.
Market.
When I started investing in India, and then I grew up in Botswana, so I moved back to Africa. And when I started investing, all the VC capital was going to 3 countries: Kenya, Nigeria, and South Africa.
Yeah.
Right, 96.5%. I still remember the number, 2016. And I was like, we're going to break this, this country trifecta. But the reality is, if you're an investor, you're looking for investable opportunities, and you can't create those investable opportunities. And they still continue to come from these 3 countries. The only new entrant is Egypt, which has really taken off from 2019 onwards, and I think that has a bunch of factors. But I think it is incumbent on investors and other ecosystem players to go much earlier to support really early stage entrepreneurs in other countries if we are going to see a pipeline at seed, Series A, and where Maria sees it. Like, if we are going to see pipeline, she's going to see pipeline in 2 years after that, right? And somebody needs to be playing very, very early. And so at Flourish, we are thinking of launching a very, very early stage fund/incubator in some of the countries where we would love to see pipeline from, but we don't. But the reality is, to answer your question bluntly, it's just 4 countries at the moment.
Yeah. Okay. Interesting. Konstantinos, let's move on the debt side maybe and see. And try to understand what type of investment criteria you see from investors in debt. So let's talk about sovereign debt and maybe corporate debt if you want.
Okay. I mean, in our conversations with fixed income investors, the focus is on 3 areas: the operating conditions, the regulatory environment, and the underlying financial fundamentals of the entity of the investee company. In terms of the operating conditions, the investors look at both the risks, and these are more macro-related, the rising debt, the governance, institutional challenges, the vaccination pace, but also investors look at the opportunities. And the financial institution, the financial market in Africa is under-penetrated, underbanked, and financial inclusion is dramatically low. So probably more than 50% of the adult population doesn't have an account. Similarly, the credit as a percentage of GDP in Sub-Sahara is less than 30%. In mature markets, it's a multiple of that. Mm-hmm. So the new technology, the mobile money, the electronic payment platforms, the artificial intelligence has the potential to unlock this potential. Now, in terms of regulation, I see a distinction between fintech investors and bank investors. The fintech investors want more flexibility. They want less strict regulation than traditional banks. They want a regulator that allows them to test new products. And I think following the success of Safaricom in Kenya, we are seeing that. I think that the regulators are more flexible than they used to be a few years back. So in Nigeria, for example, you have different licenses for commercial banks, microfinance, mobile money operators, payment platforms providers. Now, on the other hand, the bank investors, they are looking to what extent regulation is aligned with international standards. So have they implemented Basel III? Is there a resolution framework that is robust? Is it the same with bankruptcy proceedings? The investors look at this and they want that extra comfort. In terms of the financial metrics, the focus is obviously on the solvency side and on the liquidity side. On the solvency side, we look at the risks. For banks, it could be asset quality. For fintechs, it could be more like cyber risk or operational risks. And then we look at what capacity they have to absorb this risk, their earnings capacity, their profitability, and also their capital buffers. On the liquidity, we look at both the funding structure, if it's a bank, if it's deposit funded. If it's not a bank, then we look at the market funding, the diversification of the funding sources, the maturity profile, and of course we look at the liquidity, or the investors look at the liquidity of the available to meet any liabilities. And maybe another point here is, especially for banks, foreign currency liquidity is a big issue, especially relevant to what happens with global flows, and it can be an issue, especially for partly dollarized economies. So to summarize, investors, I think, look at the operating conditions, both the risk, the macro risk, but the opportunities from potential for deepening financial inclusion. On the regulatory side, they want both flexibility, but also alignment with international best standards. And on the financials, they look at both the solvency side, performance, and the liquidity of the institution.
So they look at more at certain countries than others, I guess. I mean, what are the? I mean, there's a lag maybe in sub-Saharan Africa, in West and Central Africa, compared to North Africa or South Africa. I mean, the investors prefer. I mean, what is the hierarchy of countries you would?
I think
investors like debt investors would.
I think well, first I would agree with what everybody else said, that it's a heterogeneous market. So it's not every. But there is interest in all the big countries.
Okay.
South Africa, Nigeria, Egypt has done extremely well, in my mind, over the last 2 or 3, 4 years, with the flotation of the currency, with some structural reforms. Francophone West Africa is, I hear from my colleagues, that is picking up, and of course Kenya. And Mauritius, which is more of a different animal, more of a. But we see interest in all of these markets.
Okay, excellent. And Mahin, maybe, I mean, what type of products investors have at their disposal to invest in debt products in financial institutions? I mean, what sort of products do you see, and how can we maybe try to increase the products? I mean,
yeah. So certainly, it's very traditional products that we're seeing that banks issue. Typically, senior unsecured bonds. We don't see many, and certainly there's been an increase over the past few months. But there's a bit more sophisticated products being issued. There's sustainable bonds. We saw Ecobank issuing a very successful bond earlier this year. Access Bank issuing AT1 security a couple of weeks ago. Certainly, this is excluding South Africa. South Africa is much more sophisticated in terms of issuance and the type of products. So it's plain vanilla products that we're seeing. For a lot of the banks, these are first-time issuance. These issuers have been very successful, as we've seen over the past few months. So it's very, very traditional products. And coming back to what Konstantinos was saying, that investors, they look at sovereign risk. And when you look at sovereign ratings, the majority of sovereign ratings in Africa are at the B level. That's highly speculative credit risk ratings. So you only get a certain breed of investors interested in Africa. These are frontier market investors. Investors look at yield, but they also look at the credit story. And the most successful issuance that we've seen in the past few months are banks which have a very good credit story. They've come through not just this past crisis, but several crises in pretty good shape. And when I talk about the credit story, I look at how future-proof their business models are. And this speaks to technology. And it's all about how how banks can function in the new world that we're seeing, where digital technology is being adopted. There's people who are downloading apps and doing transactions in apps. So investors look at business models and the credit story very closely. And the last point I'd like to highlight is exactly what Konstantin was saying, but also it's about capital controls. Ultimately, you need to get your money out. We've seen capital controls in Nigeria, where local international investors in local currency bonds have not been able to repatriate funds out of the country due to capital controls. And this is always in the back of investors' minds. And can they get their money out? And it speaks to regulations, it talks to politics, it talks to policy.
Yeah. And are there any securitization or any, I don't know, more like subordinate debts issued that you are aware of?
Yeah, subordinate debt, we're seeing a bit more. If you exclude South Africa, we're seeing a bit more in Nigeria.
Yeah, sure. Yeah.
A bit more issuance in the local capital markets. There's a huge demand. I mean, the pension funds in the region, they're flush with liquidity and they need to invest in securities. And so a lot more banks are issuing subordinated debt, and very successfully.
And debt investors, they're looking at ratings, I mean, international ratings, I guess, as well, a lot. And when you look at sub-Saharan Africa, for instance, they have very few banks which are rated, so that would be a problem for them, and they are not rated for reasons that we'll try to investigate in another panel. I mean, later. But I mean, what about the Konstantinos maybe as well? I mean, on the rating of financial institutions in sub-Saharan Africa, do you have any? I mean, any demand? I mean, what's the problem?
Well, I don't think there is a problem per se. I think what we are trying to do is assess the risk and give a rating that captures that risk. I think if you look at the kind of past history, the rating history shows that we've done a good job, but not everybody is.
I'm saying that very few banks are rated actually in sub-Saharan Africa.
Well, we do see some higher rated banks in Mauritius, for example. In South Africa, we had some high ratings in the past. I mean, more recently, we had to bring ratings down because of the macro angle. But the other thing that we do is that we have introduced national scale ratings where there is demand for that.
Yeah.
And that allows for more differentiation within issuers within the same country.
Okay, excellent.
And just to add to that point, the reason we're both on this panel is typically African financial institutions require not just one rating, they require two ratings for especially those who are looking to issue internationally. So we're seeing more and more banks getting ratings. Initially, typically in Africa, it's the sovereign that gets the rating first. Then it's sovereign-owned enterprises. Then it's the bank, and it's the largest banks that get the rating first. So we're seeing more and more banks getting ratings, and it's very exciting when you see development banks getting ratings. These are very, quasi-government-like institutions, and they've realized that they need ratings, and they are prepared to come under the scrutiny of an international rating agency and to be rated. So that's very exciting.
Yeah. Yeah, I'm asking the question because when we talked to European investors, on sub-Saharan Africa financial institutions' debt, the first question is always, what's the rating of these guys? Is it rated? And the answer is very often no. So we have to do something about that later. Okay, Maria, maybe. If we look at the typology of different investors, DFIs versus, let's say, private investors, what are the specific needs that the investment must have to, I mean, for you to get to invest in something? I mean, you insist probably on ESG, governance, KYC. I mean, can you tell us a little more about this?
Yeah, can you hear me? I think my mic wasn't working.
Yeah, much better.
Hopefully my loud American voice allowed you to hear something that I said the first time around. So, I mean, I would take it a bit higher than just, ESG and BI compliance. I think when you're investing with a DFI, I mean, first of all, we have a double bottom line, as we like to say. So we still want to see commercial returns, but we also have impact objectives. And at CDC, what we mean by impact, specifically with financial services, is usually along the lines of something inclusivity, sustainability, or productivity. And so that's sort of the starting point. We do like to play a role in strengthening processes and systems when it comes to governance. That includes ESG, it could be business integrity, it could be financial inclusion, but that's usually what we try to bring to the table. Something else we like to see is mobilization. So, are we helping other sorts of capital come into the investee, into the market? So this is another aspect that we like to look at. I think looking at the flip side of what we bring to the table versus other investors, we bring a bit more patient capital typically, but also CDC can bring a wider toolkit of financial products than a lot of our peers because we are a DFI and we can invest across the capital structure. What we've done with almost all of our equity investees is that over time we've provided different types of capital. So that could be senior debt, it could be subordinated, which we've done quite a bit of. It could be risk-sharing facilities, it could be technical assistance, but we have an entire, product suite that we can bring to the table with our investees.
Excellent, thank you very much. Ameya, I mean, you may have very different. What's really important for you then, as an early-stage investor, to invest in the company? What would be the criteria, the first criteria?
You have to be in the right market at the right time.
Okay, yeah.
First criteria. And I think in general, people underestimate how important the size of the market and the timing is to a company's success. You will see a lot of venture funds or early stage investors say, we just back strong teams. Strong teams can't do nothing if the market is not big enough, or if you're doing that thing at the wrong time. And so we have a thesis about how a market will evolve over time, as I was describing earlier, it's the time for payment infrastructure. And we back strong teams that are playing in that large market with a solution that we know will get adoption. And that's the most important criteria. I will also say that, just building on the comments of my colleagues at the panel, when you look at how Africa has attracted capital from a venture perspective, it has completely changed in the last 12 months. We have entered a new phase of growth in venture funding, early stage venture funding in Africa. I'm not one to blow my horn, but our 4 companies in our Africa portfolio have raised $250 million in equity funding in the last 6 months. That's more than all of Africa tech funding in 2016 when it started investing. And that's just not our portfolio. All the blue chip big investors are coming to Africa. They have realized that there is a massive opportunity. You see Tiger Global, Ribbit, Valar, all of these guys who would never do an Africa deal just 12 months ago. The floodgates have been opened. And that's because they have now seen the likes of Paystack and Flutterwave exit. And that's when they realize, okay, there's a massive Africa discount that we've been applying, and we should stop doing that. So I think in the next 12 to 18 months, we will see the gap between Africa funding and global VC funding bridge up, and investors will have to, maybe this is a controversial thing, but in Africa, a lot of investors take a lot more liberties if you look at the term sheets that entrepreneurs get in Africa versus anywhere else, because they think they have a lot of power, because supply was outstripped by demand for a long time. Yeah. And I think that's going to go away, and I think that's a great thing.
Thank you very much, Mahin. Thank you very much. If you have maybe any questions for our panel.
Hi, thank you. I'm Andrew Parkinson. I'm Mahin's colleague from Fitch, and mine's more of a comment than a question. So I know you asked about why so many banks don't have ratings in Africa, and I work on the commercial side of the business, whereas Marhin and Konstantinos work on the analytical sides of their respective businesses. So one thing they can't comment on is cost of ratings, that they're not allowed to by regulation. So ratings are costly, and I think that puts off a lot of banks getting rated in Africa, and it's the job of people like myself and my counterparts at Moody's and S&P to convince those institutions of the cost benefits of a rating. Those institutions that issue internationally, they need ratings, as Marhin said. Normally 2 ratings, occasionally 1, but normally 2, and in many cases 3 ratings. But outside of that, it's more of a marketing story, more of an ability to do sort of correspondent banking with international banks, and those are sort of the attractive elements of getting a rating for a bank. And I think the other important point that Konstantinos made as well is around national scale ratings. So, international rating agencies have some national scale ratings in Africa, but by no means across the board. And I think that's something that would make ratings in general more attractive to financial institutions, because if I go to a bank and say, go and get rated by Fitch, and they say, but you'll only rate us single B or B minus or somewhere around there, then that's quite a hard sell from my perspective.
Sure, yeah.
But if I can say to them, well, I could serve your international capital market needs with a single B rating, but I can also service your domestic capital market needs and domestic marketing with a, obviously I can't give them the rating, but, for example, a single A range national scale rating, then that sort of serves sort of 2 sort of needs at the same time, and is an overall more attractive product to those banks. So I think there's an element of the agencies, my agency included, to be more creative and better on the commercial side as well. So I think that's one sort of important element.
I think all of that is very important, and the cost of rating, yes, it's costly, but then it's the benefits. I mean, the benefits of getting a rating, is obvious. Again, European investors I met won't invest in any debt product which doesn't have a rating. So, maybe for the moment, the banks I talked to don't really need an international. International investors or to issue international bonds. I'm more on the sub-Saharan Africa myself. This is the part of Africa I know more. Like Central and West Africa, the French-speaking Africa, basically the CFA, basically countries. And what we see is that they say that they don't need a rating, and if they have one, it's bad anyway. So because of the sovereign ceiling and all that stuff, they're all at it's anyway it's bad. So it's not very interesting. So that's why I think the national rating is very important and very interesting, because you have to differentiate all these banks. When you look at Nigeria, they are all B minus, the banks basically, and some are much better than others, but they're all B minus. So from the perspective of a European investor, it's a problem.
Yeah, if all investors sort of sold it to banks in the same way that you did, you'd make my job a hell of a lot easier. So,
thank you. So, it's behind you first. This don't. Okay. Yeah. Good. No, yeah.
Thanks. Olivier Noël from Enco Capital. So we've covered fintech, we've covered the traditional space of commercial banking, but it would be good to have the panel's views on insurance, where capital requirements are actually increasing.
I'm not sure I got that.
Insurance. So we're actively looking at insurance opportunities within the continent. If you think about our mandate, particularly in regards to inclusiveness, but also developing capital markets, we understand it's a key component, and the under-penetration is incredible. So, we're actively looking for opportunities there. It'll be one of our core subsectors that we'll look at over the next 5 years.
But it's a very fragmented market. So what are the pointers? What do you look at in terms of something investable?
Yeah, well, given our dual mandate, also, we have to think about certain segments that we find attractive. So, anybody that is using, well, I think first of all, innovation in order to make products more accessible and affordable to the masses, whether that's through partnerships, which is, I think, one of the key ways forward, or through investment in technology. That's one big component. We'd love to see more being done in health insurance, although I think this would be sort of the earlier stage, more risky pools of capital that we would probably put towards it. Yeah.
Christopher Hart from Peel. Addressing the what do investors want in Africa's financial sector? When you look at Africa's financial sector, many of the companies or many of the banking groups have high capital adequacy.
Yeah.
They are, which would imply that there is only a moderate risk because of the high capital adequacy. When you look at their balance sheets, there is very little in the way of mortgage finance, for instance, which I believe is primarily due because lack of title deeds and government agencies, where you can have a title deed issued for your property, therefore you don't have security for the bank to advance finance. This affects both retail, this affects the consumer, and this affects enterprises. And the second one is, what do investors want? They want a positive return on investment. So, what about the dividend yield? What about the price book? Linking that up with Moody's, Fitch, and the other agencies, these are key areas, because if you have stable earnings going forward and dividend paying on a regular basis, investors will accord a higher premium to those companies. Your thoughts, please?
Yeah, but obviously, I mean, you want to say something, Constantine?
I'll start with the mortgage side, because we do think that mortgages is an area that is going to pick up over the coming years. I agree that the title deeds issue is a key issue, but not just that. It's the cost. It's not affordable in many cases. It's the borrower-friendly legal framework, which means that in many cases the bank cannot foreclose. And also because it's a longer-term kind of loans, which implies that the banks need to lengthen the maturity profile of their liabilities as well. So actually, I think this is also one of the reasons that I see more issuances, both public and private, going forward.
I agree.
That's on the mortgage side.
And on the return side, I mean, the investors want to profit, but I think when you look at the profitability of Tier 1 banks, particularly in sub-Saharan Africa, it's quite good. I mean, really. So I mean, it's a profitable and growing business. I mean, in these countries, really. Thank you very much. Thank you all. Thank you very much.
Thank you.
Appreciate it.